So the topic of the day today is taxation on Social Security. When is it taxed? How does it work? How much tax will you pay? What the heck is combined income? That's something that we're going to talk about today. That's how you figure out how much of this thing is taxable. Let's get into it. We're going to do 4 things in the video. We're going to talk about 1, what's the penalty if you're earning income and you take Social Security early? 2, how Social Security taxed once you've reached your full retirement age. So you don't take it early, but how does it go once you've reached full retirement age? 3, I'm going to give you a real world example of how this thing applies and explain combined income, which is the calculation that we need to use. And then 4, I'm going to end with a strategy of how you can potentially minimize your taxes when you get to retirement. First up, what happens if you've taken Social Security early meaning before full retirement age, and you have additional income outside of Social Security? So there's a limit as to the amount of income that you can earn before Social Security not only is taxed, but is actually penalized prior to full retirement age. So if you take Social Security before that, there's a cap on what you can earn before they start to take away some of that check. The cap is $21,240 right now in 2023. So if you're before full retirement age and you've elected Social Security and you have $21,240 or more of other income, they're going to penalize the check. We're not even talking taxes yet. They're going to take some of it away. For every $2 you're over that limit, they're going to take away $1 of the Social Security check. So let's say round numbers, you earn $30,000, you're roughly $9,000 over the limit. They're going to take away approximately $4,500 of your Social Security. They're just going to take it away. It's a penalty. They're going to keep it. It's not yours. They will take away that penalty once you hit full retirement age. The penalty will no longer apply. But what they don't want is somebody drawing from the Social Security system while they're still working and earning regular full-time employment money, and then just stuffing the Social Security check in the mattress or putting in the savings or whatever the case may be. Social Security is there to be a retirement benefit. If you retire early, so be it. But if you're just trying to draw the benefit out and still work, they've kind of done away with that penalty. So what happens if you've reached full retirement age and you're still working or earning other income? The penalty has gone away. You're no longer penalized, but you are subject to taxes on the money depending on the amount of combined income you have. Combined income is a certain calculation. I'll come back to that here in just a second to explain how it works. But for right now, if you're single filing a single return, you have $25,000 to $34,000 of income, you're going to pay tax on 50% of your Social Security check. So if you have less than $25,000 of income, Social Security, combined income, Social Security is not going to be subject to tax. If you're between 25 and 34 and you're filing a single return, you're a single person, 50% taxable benefit. If you're north of $34,000 in combined income, the Social Security is up to 85% taxable. Now that doesn't mean they take away 85% of the check. That means the dollar amount of your check, up to 85% of it is going to count towards your taxable income. You're gonna have to pay taxes on it. Numbers are a little bit higher if you're married filing joint. If you're married filing joint, $32,000 to $44,000 of combined income, 50% taxable on the Social Security benefits. North of $44,000 in income, if you're married filing a joint return, you hit that 85% mark. The Social Security check is up to 85% of it is subject to taxation. Now, I mentioned combined income a couple of times in there. So what exactly is combined income? The short version is combined income is your adjusted gross income plus non-taxable interest plus 50% of your Social Security. That equals combined income. Adjusted gross income, that's going to include things if you're still working a job. If you're getting pension payments, that's going to count in there. If you have retirement distributions from IRAs or 401ks, that's going to count in there. So it includes a lot. If you have interest or dividends that you're receiving, that's going to count in that AGI calculation. And then the second step, your non-taxable interest, that basically means municipal bonds, things, interest that you earn that's not subject to federal tax, which is essentially a municipal bond. If you own those and you earn interest from them, you got to add that in. And then 50% of your Social Security benefit. So you're going to add those numbers up. That equals your combined income. That's the figure they're looking at to see if you're over 25,000 single or over 32,000 joint, where they're going to start to tax the Social Security benefits. So let's do a real world example of combined income and exactly how it works. Let's tell a story about Bob and Susan. Bob and Susan are both retirees. From an income standpoint, Bob's got a pension coming in. He gets $2,500 a month. $30,000 a year in the pension. They get interest, let's call it $8,000 a year. They've got $200,000. They're earning 4% on it, so they get $8,000 a year of interest. And then they each have a Social Security check. Let's say that Bob gets $2,000 a month and Susan gets $1,500 a month in Social Security, so $24,000 a year for Bob, $18,000 a year for Susan. So if we start to add that up, we got $30,000 in pension income, $8,000 in interest income, and then the Social Security checks, what do we say, 24 and 18, 42, have that $21,000 of taxable Social Security going in, or $21,000 of calculation of Social Security check, half of the benefit going into the combined income bucket. So they're going to be north of $44,000 there. That's too much head math for me, but I'll put it up here on the video. They're certainly going to be north of $44,000. So those Social Security checks are going to be included in their taxable income up to 85% of that check. That's a real world example for you. Combined income adds up quickly because it counts any interest that you're earning, any pension distributions. I didn't even get into IRA or 401k distributions for Bob and Susan. We assumed that they didn't have any of those, and they were still over the combined income threshold to where their Social Security check is going to be taxed. And so here you go. Here's the tip of the day. How can you minimize the potential taxes on the Social Security? Well, if you have a pension coming in retirement, if it's substantial, you're probably stuck, right? I mean, if you got a few $1,000s a month from a pension and a couple $1,000s of Social Security coming in, you're most of the way there already. But if you're not in a pension situation and a lot of your retirement money is 401ks and traditional IRAs and things like that, those distributions are going to count. Do a Roth conversion. If I've said it once, I've said it 156,000 times on this channel. Do a Roth conversion. A benefit to that is that those distributions, once the money's Roth, not subject to taxation, not included in combined income, so you can live off of some of your retirement money without triggering more taxes for yourself. So hopefully now you've got a better understanding of how taxes work on your Social Security. It's not just earned income. Lots of things go into that calculation for combined income, and it can subject your Social Security to some pretty hefty taxes. If you enjoyed the video today, come back, subscribe to the channel, check it out. We got lots of videos about retirement planning, and the financial markets in general. I hope you enjoyed the video. I thank you for being here, and I'll see you soon.